Did you know your chances of being audited by the IRS are less than 1%? In fact, for the vast majority of Americans, your odds are around 0.17%. However, there are certain red flags that can significantly increase your odds. So, in this video, I want to take you through some of the IRS data to kind of look at your odds of being audited. We're going to kind of break down these odds by income, different other filing features. We'll look at the major causes of common audits or examinations and kind of give you an idea of what to be on the lookout for when you file your return. Now, my name is Scott Caufield. I am a CPA and CFA charter holder and the founder of Sophos Wealth Management. So first, we'll look at a quick table. This comes from the IRS data. It's actually put together by the GAO office. This was based on 2019 IRS audits. For most Americans in 2019, I think the average was only 0.25% were actually audited, although I've seen other years a little bit higher, closer to like 0.43%. But overall, 2019, very low audit odds. If you're either in the 25,000 to 200,000 income level, your chances are only 0.17%. Same thing for those in the 200 to 500,000 level. As you get up to half a million to a million, you're kind of climbing. As you get 1 million to 5 million, now you're over a 1% chance, still very low. And those with 5 million or more, still quite low at 2.35%. Interestingly, those in the low income bucket are more likely to be audited than those in kind of the high to fairly high level. So if you've got less than $25,000 of income, but it's still positive, your chances are 0.4%. So that is higher than average. And if you look at the far right of the table, those with only an earned income tax credit, your chances are quite significantly high at 0.77%. So one of the things a lot of people don't like about the IRS is, a disproportionately high number of low income people are audited. Although, maybe they have reasons for doing that. There may be higher levels of fraud in those or mistakes, but who knows? So, I mean, it's kind of obvious to say, but those super high earners are going to be at quite higher risk. If we go to the next table here or next chart, this comes from the IRS. This is their IRS data book in 2023. And this shows the trend of IRS audits over time. So the chart on the left shows the audit odds for those under 100,000 from 2013 through, we have through 2019, we know officially, because the IRS can audit you for up to 3 years after you file. And then 2020 and 2021 are kind of what we have so far, but those numbers will bump up as more audits kind of happen for those years' returns. But you can see for those under 100,000, odds are pretty low. Highest odds for those under 100,000, again, are those in the 1 to 25,000 bucket. Those at the 25-50 bucket or the 50 to 75 or 75 to 100, quite a bit lower. But all of these are actually higher for the most part, I think, than the table on the other side. That was based on the 2019. So those were some of the lowest relative to past history. As IRS funding has gone down and down over time, there are less and less audits. Now, as you bump up to income, the 100,000 to 1 million range, you can see your odds of auditing are fairly higher. 100 to 200,000, even 200 to 500 are still pretty darn low. But those in the 500 to a million range, now you start to get some chances of audit, although still, less than 1 in 100 on 2019 data. It's not until you get into that million plus, the table on the right or chart on the right, that you get, better chances of being audited. It used to be if you had a $10 million or more return, you used to have a 10% chance or more. But even on those, that's kind of dipped lately. So, it's not really that surprising, but the very high net worth people, the very high earners are typically at the greatest odds of being audited. According to Track IRS, TRAC, this comes from University of Syracuse. They put together IRS data, and they found that back in 2019, they had an audit rate of about 0.38%. But those who had Schedule C income, so those are sole proprietorships reported on your business return, the audit rate went all the way up, more than double, to 0.8 to 1.6%. So quite a bit higher. And they also found that higher income returns that either had a Schedule C or Schedule F, F for like farming income, this is in the 200,000 to 1 million income range. Well, they had without a Schedule C or F, they had about a 0.49% chance of being audited. With it, they had a 1.03. So it went up quite a bit. Now, the IRS likes to report actually quite a bit higher audit rates than I think are necessarily real. So when we talk about these 0.17% chances or 1% chance, that is basically that you get any kind of compliance examination from the IRS. This following will show the IRS data for 2023, what type of compliance activities happen. So they will call all of this basically an audit. But in my opinion, the vast majority is not really audits. So the number one most common thing on 2023 data was math error notices. And then the rest are things like automated substitute for return, automated underreported. The ones that I think of and most people think of as traditional audits are going to be your correspondence examination and field examinations. That's when the IRS is actually challenging or having you provide supporting documentation for things like your itemized deductions or your business deductions. They're getting actual data. Most of the math error things or the underreported things. I mean, an underreported is pretty simple. It's, hey, somebody reported a 1099 saying this, you either didn't report it or you reported this. It was too low. Explain the difference. Or, they just want you to figure out the difference. Those are actually fairly straightforward and simple. If we look at, actually, I'll just show you the math errors that they showed. So if you look at these kind of types, I think it's pretty explanatory what you want to be on the lookout for. So in 2022 returns, the most common math error was child tax credit. You have two parents who both file separate returns, maybe they're divorced or separated, and they both claim the same child. Well, that's going to create an error. Recovery rebate credit. So that was the COVID stimulus. You had people, IRS would say, "Did you get a stimulus check?" That was a tax question on the return. A lot of people said no, when in fact they were sent a check during the year. They just kind of forgot about it. And so the IRS said, "Oh, no, no, your return is wrong." They just call that a tax or a math error. So you can kind of see all these things. The most common ones are just kind of like, I would say, fairly easy things, double checking that parents aren't double claiming a child, double checking, back when recovery rebate credit was a thing, whether people got it or not. And then some of the other just calculations, making sure there's not kind of these easy errors. Now, standard versus itemized, itemized deductions is an area that people want to be kind of on the lookout for. But I think it's good to know where these math errors are coming from. So all this kind of get into what you should think about. Okay, so on your return, we know what some of the data shows, but what should you kind of think of as the flags on your personal return? A few that I would go down. I mean, high income, there's really nothing you could do about it, but obviously, if you have too high of income, that's going to be a flag. And those, again, with very low income, around like the earned income tax credit, I think you see two things there. One, sometimes people there are maybe just more prone to make mistakes. Two, because there are such generous credits around things like the earned income tax, you do get a fair amount of probably fraud and that kind of stuff. So it makes sense to me actually that the IRS does look at it at a higher rate. Like anything, you just want to make sure you're reporting what actually happened. Now, another red flag, nothing you can really do about it, but if you are self-employed, filing a Schedule C, I believe, I don't have the date on this, but I would almost guarantee those who file Schedule E, like rental incomes, also quite a bit higher chances of being audited. There's just more gray area. There's more uh, vulnerability to mistakes, but also to fraud. So I would expect those things to be audited at higher rates. Also, when they are auditing those things, they're going to have sort of a set of the standard that they're expecting. If you are like me, in my business, wealth management, I am the main product. So the IRS probably would not expect super, super high expenses relative to my revenue. Whereas somebody who maybe is a contractor on a construction project, you're going to have way higher expenses relative to the revenue for all those materials you're buying. But there's just kind of standard things people expect to see. I did some tax work back in the day, and I remember seeing people who might report income from W-2 jobs of $200,000, but then they would report a side hustle, a side self-employment gig, bring in 2,000, 5,000 in revenue, and try to claim like 60,000 in expenses against it. And it's like that just doesn't pass the smell test unless that's some startup business with massive upfront costs that you expect in year two to really see a huge jump in revenue. That just looks like somebody trying to take advantage of the IRS. And, more likely than not, that's the kind of thing that they would look at. Another one, and this is just kind of obvious, is discrepancies in reported income. So If your income, W-2s, 1099s don't match, unfortunately, it's just easy to forget that stuff. If you can pull a transcript from the IRS of everything that's been reported to them before you file, that's always great, but sometimes it's not available. It's a pet peeve of mine. I wish for most people who had simple tax returns, the IRS would just say, "Hey, here's what we have reported for you. Let us know if you need to make any changes." And you could just click, click, click and be done. But unfortunately, that's not the world we're in. Another flag that I already kind of mentioned is just large deductions relative to your income. So if you've got really heavy business expenses, or you've got this side gig that maybe has huge expenses with almost no revenue, that may look more like a hobby. That may look a little suspicious to them, especially if you're a high earner. And one of the areas I've heard, I don't know statistically, but I've heard that IRS looks very closely at things that are often hobbies like horses, for example. Anything to do with a horse, if you try to claim it as a business, is much more likely to be looked at. And I've heard that with other kind of one of these hobby businesses where it's on the line tend to be looked at more closely. Also heard that cash intensive businesses more likely to be looked at closely. You hear stories about the IRS looking at home office deductions frequently. Oftentimes it's not solely working out of the home, or the home office is not solely business use, but that's not a huge deduction. So I doubt it's all that material. Another one that would seem obvious, but IRS would be looking at round numbers. That's an indication that people aren't, looking at true receipts and aren't actually tying things out, but they're just guessing. You especially see that on donations or Schedule C business expenses. And then another one, again, not a lot you can do about it if you have it, but around foreign income assets, expenses and reporting, that kind of stuff. That's a scrutinized area. So reportedly, that the IRS looks a lot. So hopefully this gives you an idea of things to think on. I mean, for most people, the low hanging fruit is just making sure that you've received all the documents that were reported to the IRS, that you reported them all, you double check all those sources. Now that everything gets emailed rather than mailed, paper mailed, I think it's a lot trickier. Did you remember to download that 1099 of interest from that savings account? Kind of easy to miss those things. Fortunately, most of those will result in just a quick and easy, uh, that quick and easy math change rather than a full blown examination. That's kind of the painful, what I think of as traditional audit. So, anyways, appreciate you tuning in today. Like the video, subscribe to my channel, and share with anyone you think would benefit. Thanks.